Hussbus bus stop. JP Hussey here, owner of the Hussey Team Mortgage Advisors, with this week's Hussbus bus stop. Hope you're good. Today I want to talk about something important that you should know about qualifying for a mortgage and probably the biggest factor of getting qualified for a mortgage, and that is your debt to income ratio. You may have heard about this before. Sometimes people call it DTI. In our world, there's a lot of acronyms, okay? DTI means debt to income ratio, and it's in the top 3 of the most important factors of qualifying for a mortgage. So let's simplify this so you can understand how it works, all right? So if you see my little screen over here, I hope you can see it, all right? I wrote it out. So you got debt to income ratio. And what that is your total monthly payment debts, the minimum payment on a credit card, your car loan, that future effective mortgage payment, all right, with taxes, insurance, HOA fees, principal and interest, that all added up. Add it all up. I'm going to give you an example, all right? And then you divide that by your total gross, right, before taxes. All right, we get that question a lot. Monthly income, all right? And that, when you divide that, it spits out a percentage, all right? And that is your debt to income ratio. Now, in most situations, all right, some products go higher with this or that, all right? The max is usually that ratio about 49 to 50%. So think about that number, all right? If it's 50%, let's just say, that's saying, all right, that all of your monthly liabilities, your debts, including that mortgage payment, is 50% or half, okay, of money going out, all right, of your gross income. And we know what gross is. That's before taxes. So your actual money coming in is less, all right? Half of it. This does not include groceries you have to buy, kids stuff that's not on your credit report. It's not being factored in, all right? So think about that. If half of your money is going to just pay things on your credit report, how are you going to live, okay, with other things you got to pay for on that income? So that's why that max, which really, it's pretty high, right? It's 49 to 50%, but can get qualified there. Okay, FHA loans will go a little bit higher. There's no doubt. There's a lot of other factors taken into account, but this is number 1 or number 2 or number 3 of the most important things when qualifying for a loan. That's what we look at. Obviously, you got credit score, how much money you're putting down, a lot of different things, but this is a big one. This is the one we battle with all the time. This is how we pre-approve you, all right? We give you the max of figuring it out based on the documents you give us, all right? That's what debt to income ratio is. So let's do a quick example. If you have a credit card, all right, even if you pay $500 a month to that credit card, you pay extra. That's really good, by the way. Excuse me. But the minimum payment is $50. All right, hope you can see this little chart. Excuse me. Car loan is $400. And then you got the future mortgage. Okay, remember, you don't have that mortgage yet, but we're looking at it. We're grabbing the taxes, we're grabbing the insurance, principal and interest rates, this or that. It's $2,500 per month. You add those up, you got $2,950. Now let's say, do a little math here. Let's say you make $72,000 per year gross. Okay, that would equate to if you do 72,000 divided by 12, that's $6,000 per month. So all we do is we come down here and we divide $2,950, which is over here your debts, all right, on that credit report and the future effective mortgage. We divide by 6,000. And that spits out, it'll say 0.491666, right? That would be 41. Let me bring this back up here. There we go. 49.17. So that's your debt to income ratio. And that's just about half of your gross income, right? So that's really the max. In most situations, your credit score is real low. We're not going to be able to go that high. Your credit score is real high. Usually you'll get approved for stuff like that, okay? But that's really the max. And that's how debt to income ratio works and how we pre-approve you when we pre-approve you. That's the probably the biggest factor. So I wanted to explain this because a lot of people will say, well, I have a good credit score, or I've always paid my bills on time. I'm putting a lot of money down. That's all well and that's good. But at the end of the day, it's coming down to this because this is important. More than half of your debt is going out of what your income is. What makes you think you're going to be okay living, right? People talk about being house poor, right? All the time. Going up to 50% or more could put you there. Now, this is all things on paper. You might have other income, this or that, but they work on paper, right? So that's why we need these documents up front. We want to make sure it's good. We want to protect you because this is one of the biggest factors when buying a house. I hope you have a great day. Hussbus, bus stop.